morning has been outside the studios or for that matter anywhere you are as to how sweltering hot it has become in Mumbai. In fact, the heat wave hit the city right here on Monday as the maximum temperatures recorded by IMD's Santa Cruz Observatory showed up nearly 5 degrees in a day to almost hitting 38 degrees, which is 7 degrees above normal. In fact, an independent meteorologist also said that temperatures in Colaba were recorded at 34.7, which could reach to 36 to 37 degrees today, that is April 16th. Is expected to be the day of peak temperature, even as the IMD issued a heat wave alert for Mumbai. And I don't think we can deny that. With the humidity in Mumbai, it feels like above 40 already.
That's weather for you. And for the longest time I've lived in Mumbai, I mean almost 2.5 years now. In April, to imagine that the mercury in Mumbai is going to be anywhere close to 40, I think
is unimaginable.
Was unimaginable. But that's the reality. Bangalore 38 degrees, Delhi nearing 40 degrees, Ahmedabad crossing 40, global warming folks. And this is the real deal right now. We can deny it, but we need to accept it that the weather patterns are changing.
If only we had summer vacations, then we would have made the most of it.
You
because
still have to wait until June for that.
Some schools are declaring early summer vacations also.
We're getting a lot of offs actually this month.
Yeah, that is.
Tomorrow already is.
Yes,
so yeah,
that's
just
right.
in case. But it's getting hot for the global markets as well. The kind of impact that one has seen of the geopolitical tensions. Although of course there's been a massive recovery as well, which one has seen, and a lot of volatility too.
I really hope it's like a heat wave for global markets also. It's nothing more than that, because frankly, if markets had to and react to what is happening, at least on the political front, then by now crude would have really shot up close to $100. We would have seen impact of that already in some of the other financial markets and sensitive markets, at least like Middle East, and what could happen in some of the other sensitive equity markets. That's not happened. But you can't deny the fact that globally markets are going through a corrective phase. As of now, the macro positioning is not looking that exciting. Bulls are no longer on a front foot. The lay of the land is clearly indicating that in the near term, I guess it's very easy to conclude that we've hit both locally and globally a patch of resistance. The snowball into a big fall is our global market simply correcting after the recent run-up what we've seen. I guess a combination of both. You cannot deny what is happening on the macro front. The chatter around that, okay, no rate cut in 2020, that chatter has already started. Brokerage reports have already started out establishing that we could be in for a rate cut. So that narrative, which was the missing link in terms of where rate action and inflation would move, that has started. Then on the other front, you've got the headwind, which is on the geopolitical front. So I won't use the word scary, I won't use the word alarming, but I would use the word messy and sticky. Let's see if this is a passing phase or this will snowball into something very large. I think that is how you need to read the setup as of this Tuesday morning.
In fact, the Brent has already seen an escalation of about almost 0.6% overnight. So we are now nudging that $90 per barrel mark. Similar has been the price action for precious commodities, metals like both gold as well as silver, which already are at a record high and have seen further escalation as well. Just very quickly to the global market picture as well. While you did see a bit of a recovery when we were, closing for trade for the US futures, but that's not how the markets have closed. The Dow knocked down another 250 points overnight and close, a 1.25% decline coming in for the S&P, and the Nasdaq as well plunged almost about 2%. Similar was the case for the broader index, that's the Russell 2000 as well, which also saw a decline of about 1.5%. Asia clearly taking heat from what transpired in US equity markets overnight. And China, though, has managed to beat the GDP expectations, which is why China perhaps was the only world market which was a standalone case in that sense, which actually held out in trade yesterday. But that's not the case today. That the GDP print has, been unable to enthuse the street, still lower by about 1% for Shanghai. And across the street, you are seeing cuts of as deep as 2.5% for Korea, 2% lower, which equates to about 750 points for the Japanese Nikkei, and the periphery markets as well are bleeding as we speak. In fact, the GIFT Nifty too in the red, so a further decline of 200 points is what the Nifty implied open is already indicating.
You know, sticky, messy. I think that's how we can describe yesterday's trade as well. Just to put it into perspective, it was a sea of red. So yes, to a certain extent, global sentiment did impact us with a 1% cut on the frontline indices. The auto markets were not spared. And there was a whole host of losers as well. L&T, BCL, Bajaj, Finserv, all of those stocks did buckle under pressure. With heavyweights like HDFC Bank, for instance, ICICI Bank putting pressure on the Nifty Bank Index, and real estate as well as IT also succumbed to selling pressure. Across the board, PSU Bank, the LME ban impacting the entire metal space. And yes, we're looking at the rest of the globe in the 3-day move. While we've declined about 2% as compared to what we've seen in Hong Kong, etc., it hasn't been too bad. But yesterday was carnage.
See, carnage is actually a slightly extended word. Why? Because for me, at this kind of level, 3-4% is what I would really call as a carnage. I mean, 1% I would still say that the markets were looking for a reason to correct and there's a reason to correct. But how do you read into the setup? See, of late, Indian markets have outperformed global markets. Even though the global correction has kicked, Indian markets have done rather well for themselves. So are we likely to outperform? That's number one. Number two, even if markets they peak out, are we in for what could be called as a typical market correction, which is that things will be volatile, the sell-off will be very sharp, the sell-off will be very swift, and the sell-off before you realize actually will get over. What is disturbing for me is the fact that FIs they're still sellers, and even though yesterday FI versus DII was a net neutral number, markets they still fell. So while as of now, I think you can easily assume that market will run into resistance and there would be a bout of volatility and sharp sell-off if global picture deteriorates. But for me, what really matters is that what tone now HNI investors and retail investors they do. Today's picture, especially FI versus DI, let's put it on one screen, was a net neutral number. Yet markets they fell. So becha kaun? I mean, obviously there was unwinding at the HNI level or at the retail level. Otherwise, markets would have not fallen in kind of a jiffy. So that's a gray area for me, which is that look at the market trajectory. I think you've run into resistance. Cues are just not supportive, and FIs are selling, DIs are buying, but markets are yet falling even though number is neutral. That means somewhere unwinding has started at the local level. This could be opportunity, this could be profit taking, this could be pure skim from the top, very difficult to fathom, but you need to just say that, okay, I'm going to take a deep breath before I start going now.
Yeah, and I guess, everyone must be wondering at a time when you're already sitting at record highs for most indexes and of course individual stocks as well, how do you protect? And for the more near-term and tactical, movers or players in the market, they must be wondering whether to short this market right now.
So, Aisha, you should short the market. Why? Because you don't know how sharp the turn is going to be. Typically, it's a market where you should not short until and unless something really changes at a global level. Second, we are in for a volatile patch because of macros. Commodity producers will do well, commodity consumers are unlikely to do well, which means a further selling or numbness in, let's say, autos, in capital goods. Those pockets in the near term cannot be ruled out. Third, I think from an earnings season standpoint, I don't think we are in for any big upgrades. Since we are not for any big upgrades, this time around the earnings season will have a very diluted impact. It will be very stock specific, and in general, I think brokerages are unlikely to upgrade their targets at this higher base warning season. So the trigger actually in the market is not there. So it's going to be sentiment. It's going to be individual stock reaction, and a lot will now be dependent on flows and what HNI positioning would be in the run-up to the election. We are talking about it, but we are not realizing that election is starting soon, and the chatter will start soon. So the positioning by HNI and retail would be the key to understand which way things would move in the run-up to the election result.
If you like this video, then like, share, and subscribe to ET Now.